Hi folks, and welcome to Become Financially Independent. My name is Björn for those who don't know me, and in early 2020 the bull run has ended with the coronavirus pandemic and resulting in an economic disaster. However, as of August 2020 the market is back to an all-time high, and whenever there's been an extended bull run, one question that comes to mind: should I invest in the market now or wait until a pullback? So let's dig in and see what is the better approach. And there is this awesome case study, even God couldn't beat dollar cost averaging. The Ritholtz wealth management analyst Nick Maggiulli wrote on his Off the Dollars and Data blog. And no worries, I will link the awesome article in the description below. So in that study, Maggiulli set out to prove dollar cost averaging DCA as historically outperformed the buy the dip approach, even when the dip buyer absolutely nails the timing, which of course is next to impossible. And here's how he breaks down his research. Imagine you were Marty and you go back somewhere in history between 1920 and 1980, and you have to invest in the US stock market for the next 40 years. And Nick uses here the S&P 500 index. The Standard & Poor's 500, or simply S&P 500, is basically a stock market index tracking the performance of the 500 large companies listed on the stock exchange in the United States. So it is one of the most commonly followed equity indices. That a little excursus what is an S&P 500. But now imagine you have two investment strategies to choose from. DCA, beat dollar cost averaging. You invest basically 100 inflation adjusted every month for all 40 years. Or buy the dip, you save $100 inflation adjusted each month and only buy when the market is in a dip. Not only will you buy the dip, but I'm going to make you God or Marty from Back to the Future about when you buy. You will know exactly when the market is at the absolute bottom between any two all-time highs, okay? This will ensure that when you do buy the dip, it is always at the lowest possible price. The only other rule in this game is that you cannot move in and out of stocks. Once you make a purchase, you hold those stocks until the end of the time period. So, which one is better? Well, that's got to be a pretty obvious choice, right? But write down just now in the comments what you think which will better perform. Logic-wise, it should be buy the dip, right? Write it down, write it down. Nah, not so fast. According to Nick's numbers, his point in all of this is that buy the dip, even with the perfect information, typically underperforms DCA. So if you attempt to build up cash and buy at the next bottom, you will likely be worse off than if you had bought every month. Why? Because while you wait for the next dip, the market is likely to keep rising and leave you behind. And investing legend Peter Lynch once said, far more money has been lost by investors preparing for corrections or trying to anticipate correction than has been lost in corrections themselves. Think about it. And what makes the buy the dip strategy even more problematic is that we have always assumed that you would know when you were at every bottom. You won't. He ran a variation of buy the dip where the strategy misses the bottom by 2 months, and guess what? Missing the bottom by just 2 months leads to underperforming DCA by 97% of the time. So even if you are somewhat decent and calling bottoms, you would still lose in the long run. Here you have it, guys. Therefore, I really recommend checking out the study to have the full picture. And not only that you will miss the dips and the entry points, every time you sell, you have to pay taxes to the state and fees to your broker, which can be, if you sum it up over decades, be an impressive amount of money. So my advice, go long. And the other point is, if you wait and each day you have not invested your money, you miss on dividends and the increase of the share price, as you can see here as well on the study from JP Morgan. So, to sum this up, rewards come from risk, and without risk, no rewards. Therefore, I hope I could take away your doubts and encourage you to just start investing. I mean, literally right now. And the easiest way to do so is go to your broker, or if you don't have one yet, Google and search for the best online broker in your country with the lowest fees and the most ETFs, exchange traded funds, available, and set up a savings plan where you put, for example, let's say $200 each month automatically in 2 ETFs. Means $140 in an MSCI World Index and $60 in an MSCI World EM Index. EM stands for emerging markets like China, South America, Africa, etc. Right? And like that, you have covered all the world and you are well diversified if you don't want to take the risk in investing in single stocks. If you, however, feel comfortable in investing in single stocks and you need ideas which ones to invest in, check out my other videos. There you will find some ideas. That's it for today. I hope you liked the video, and if so, kindly give it a thumbs up. That would help a lot. Have a great day, and remember, stay focused and don't get greedy. See you all next time.